I want you to imagine something for a moment. Let's say you're going away for 2 weeks, so somewhere with limited phone access. You cannot check in on the business every day. So what happens to the business finances while you're gone? Do your invoices still go out on time? Does someone know which supplier payments are due and when? Is there a clear picture of the cash position so the right decisions get made? Does the business keep running financially the way it should? Or does most of that live in your head? So for small business owners, mostly the honest answer is that a significant amount of the financial management of the business depends on them being present. So paying attention and carrying a running total of obligations in their memory. And you know what? That works until it doesn't. Until they get sick or you go away or the business gets busy enough that keeping track in their head is no longer possible. And then things start to slip. The difference between a business that runs smoothly and one that is constantly feeling like it's on the edge of financial chaos is not how hard the owner works. It is whether the business has the systems in place or whether it has a person trying to remember everything. So today I want to walk you through the 3 financial systems that every small business needs, not concepts, actual systems with the specific steps to build them using tools you probably already have. So hi, I'm Jen Richardson and I'm the founder of 123 Financial Group. We work with small business owners across trades, construction and service industries. And building the financial infrastructure of a business is one of the most practical and high impact things we do with new clients. What I'm going to walk you through today is the exact framework that we use, the 3 systems in order of priority with the practical steps to put each one in place. So before I walk you through the 3 systems that we use, I want to make the case for why this matters so much, because I think a lot of business owners underestimate it. When the financial management of a business depends on a person rather than a system, 3 things happen consistently. The first one is that things just get missed, not because the owner is careless, but because there is a limit on how much any person can hold in their head while also trying to run a business. So when the system lives in memory, the quality of the financial management is directly tied to how much bandwidth the owner has on any given day. The second is decisions get made on incomplete information. If the only financial picture available is the bank balance and a rough sense of what is coming up, decisions about spending, hiring, quoting and growth are all made on guesswork rather than data. And the third thing is the owner cannot step back. So when everything depends on them being present and attentive, they are trapped. They cannot take a holiday, delegate properly, or even have a bad week without the financial management of the business suffering. Systems is the fix for all 3 of those things. They make the business independent of the owner's memory. They make financial information visible and reliable, and they make it possible for someone else to step in without everything falling apart. A business with strong financial systems does not feel like it is being held together. It feels like it's actually running. So the first system is visibility, the ability to see what is actually happening financially in your business at any point in time, not just at the end of the year. Most business owners have access to this already through Xero. The problem is not the access, it is knowing which report to look at and what to look for in each one, and of course, how often to look. So let me give you the specific reporting rhythm that I recommend to my clients, because this is the part that most people have never had explained concisely to them. So weekly 5 minutes is number 1. Every week, I want you to look at your accounts receivable aging report in Xero. This shows you every outstanding invoice, how old it is, and of course, who owes you money. 5 minutes once a week. This single habit alone eliminates most debtor problems before they become cash flow problems. If an invoice has been sitting unpaid for 35 days and you have only noticed at the end of the month, you've already lost 2 weeks of follow-up time. If you check weekly, you catch it at 7 days overdue. So monthly, the 30 minutes test is to look at 5 numbers. So once a month, run your profit and loss report for the financial year to date. And I want you to look at these 5 things. So revenue compared to the same period last year. Is the business growing, flat, or declining? Gross profit margin. Is it holding, improving, or narrowing? Your 3 target expenses categories. Are any of them trending higher than expected? Your net profit. What has the business actually earned after all your costs? Cash in the bank versus cash owed to you in outstanding invoices. That gap alone tells you about your cash flow timing. So that's 30 minutes, 5 numbers done every month without fail. This review will surface almost every significant financial issue before it becomes a crisis. And then quarterly, 60 minutes is all it takes, and there are 3 questions. 4 times a year, I want you to sit down and ask yourself these following 3 specific questions. The first one is, what is my approximate tax position? If the year ended today, run your year-to-date profit and apply your tax rate. This keeps the annual bill from being a surprise. The second one is, are my prices still covering my costs? So run your gross profit margin and compare it to the same quarter last year. If it's narrowed, something needs to change. And the third thing is there anything in the next 90 days that needs financial planning? A large equipment purchase, a seasonal slowdown, a BAS payment larger than usual. Name it now while there is still time to prepare for it. That is the visibility system. Weekly debtors, monthly P&L, quarterly strategic review. It takes you less than 2 hours a month, and it gives you a full financial picture that most business owners only get once a year from their accountant. The second system is how your money is physically organised. And this is where I want to go further than the general advice you might have heard before about separating your money. So most people who have heard this concept set up 2 accounts, an operating account and a tax account. And you know what? That is better than 1 account, don't get me wrong. But a 4 bank account structure gives you meaningfully more control and visibility with very little additional complexity. So here are the 4 bank accounts, what each one is for and how it gets funded. So account number 1 is your operating account. And this, of course, is where all your revenue lands and all your operating expenses are paid for. So think of it like your wages, your materials, your subcontractors, your supplier invoices, software subscriptions, fuel cards, everything that relates to running the business day to day comes out of this account. The discipline here is that this account should never be used to pay tax, never be used for personal drawings beyond your agreed wage, of course, and never be rated for a large discretionary purchase without a planned transfer back in. Account number 2 is your tax holding account. So every month I want you to transfer an amount equivalent to your estimated GST liability and income tax provision into this account. It sits there untouched until BAS or your tax is due. The funding rule is to transfer at least 10% of gross revenue for GST, plus an additional amount based on your estimated net profit and tax rate. If you're unsure of the right percentages for your structure, ask your accountant to give you a specific figure. Then automate the transfer so it happens without you having to think about it. And when your BAS is due, the money is already there. And of course, when the tax bill arrives, it's also already there. The account earns a small amount of interest while it waits, but more importantly, it makes the tax bill a non-event instead of a crisis. So account number 3 is your cash flow buffer account. So this account exists to cover the inevitable timing gaps in your cash flow cycle. The weeks where several expenses land before a large payment arrives, the seasonal slowdown, the unexpected costs. The target balance for this account is 4 to 6 weeks of operating costs. So if your weekly operating costs, including wages, are say $20,000, the target is $80,000 to $120,000 sitting in this account. That sounds like a lot, but if the business does not have it yet, building it takes time. But the discipline is to transfer a fixed amount into this account every month until the target is reached. Then leave it there. It's not a savings account, it's an operating shock absorber. The business owners who sleep well are almost always the ones who have this buffer in place. The ones who lie awake doing mental arithmetic about whether there is enough to cover payroll on Friday are the ones who do not. And account number 4 is the owner's account. This is where your wage or drawings land. A fixed, planned amount transfers into this account on a regular schedule, just like any other employee wages. Not whatever is left over, a planned amount. I will talk more about this in the next video, but the principle matters here. Your income from the business should be a planned, consistent transfer, not a variable amount that depends on what is sitting in the operating account at the end of the week. 4 accounts, each with a specific purpose, each funded according to a clear rule. Together, though, they transform a single pool of money where everything is mixed together into a structured financial system where you always know exactly what each dollar is for. And the third system is the one that makes the other 2 actually work in practice. It is the rhythm, the regular cadence of financial actions that keep the business financially healthy without requiring the owner to constantly think about it. Without a rhythm, even good systems degrade. The Xero reports do not get looked at. The tax transfer does not happen. The buffer account gets rated for something urgent. And gradually, the structure collapses back into the single bank account and a running mental total. The rhythm prevents that. Here is what it looks like in practice. The weekly rhythm. Remember, 3 actions, 15 minutes total. Action 1 is to check the accounts receivable aging report. Follow up anything more than 7 days overdue. Action 2 was to review what is due to be paid in the next 7 days. Make sure the operating account has the funds. And of course, action 3 was to reconcile your Xero transactions for the week. If you have a bookkeeper, confirm it has been done. If you are doing it yourself, it takes less than 10 minutes with a properly connected bank feed. These 3 actions done every week keep the financial picture current. Nothing builds up, nothing goes unnoticed, and the monthly review becomes a 5-minute confirmation rather than a 2-hour reconstruction. The monthly rhythm was 2 actions, 45 minutes total. Action 1, remember, was running your month-end review using the 5 numbers I described in System 1. So the revenue, gross margin, your major expenses categories, your net profit, and the cash versus receivable gap. Action number 2 was to check your bank account balances against their targets. Is the tax account on track? Is the buffer account building as planned? Did your owner's wage transfer correctly? If everything is on track, this takes 20 minutes. If something is off, you have identified it at the end of the month rather than at the end of the year. And of course, your quarterly rhythm is 1 action and it takes about 60 minutes. Once per quarter, do the strategic review I described in System 1. So check your tax position, check your margins, do your forward planning for the next 90 days. And once per quarter, send your accountant a message. Not a full meeting necessarily, just a check-in. Share your profit and loss. Flag anything you are uncertain about. Ask whether there is anything you should be thinking about before the end of the financial year. This is the cadence that the business owners I work with who feel most in control have in common. Not because they are more financial than anyone else, because they have made this rhythm a habit. The Xero setup that makes all of this possible, of course. And for this rhythm to work without consuming hours of your time, your Xero needs to be set up properly. That means your bank feeds are connected and reconciled regularly. Your chart of accounts is organised so reports are meaningful. Your invoicing is set up with automatic reminders. And your reporting is bookmarked so you can access the 5 numbers in under 2 minutes. If your Xero is not set up this way, or if your books are behind and the reports are not reliable, that is the first thing to fix. Decisions made on unreliable data are worse than decisions made on no data, because at least with no data, you know you are guessing. So when these 3 systems are in place and running together, the experience of managing a business financially changes completely. The bank balance is no longer a mystery. You know what it means, what it is already allocated to, and what is genuinely available. The tax bill is no longer a shock. The money is already sitting in account, earmarked and waiting. Cash flow pressure is no longer constant. The buffer account absorbs the timing gap that used to create weekly stress. And the monthly review gives you a moment every 4 weeks where you sit down, look at the numbers and make decisions from a position of clarity rather than uncertainty. That is not an aspirational state. That is what a structurally sound small business looks like, and it is available to any business that is willing to build the systems. So here is a question to sit with honestly. Of the 3 systems I have just described, how many does your business have fully in place right now? A real-time reporting rhythm, a 4-account bank structure, a weekly, monthly and quarterly financial cadence. If the answer is all 3, you are genuinely in good shape, and the focus should be on maintaining them as a business grows. If the answer is 1 or 2, you have a clear picture of where the gaps are. And if the answer is none, well, that's not a judgment. It's a starting point. And the most important thing to know is that all 3 of these systems can be built in a matter of weeks, not months. And of course, if today's video has made you want to take stock of where your business stands financially, my Profit Engine Scorecard is the right starting point. It has 15 questions across 3 areas, so financial clarity, business structure, and profit growth. The control section in particular maps directly to the systems that we have covered today. 10 minutes to complete, and it gives you a clear picture of where to focus first. The link you'll find in the description. And of course, if you want help building these systems in your business, whether that is getting your Xero set up properly, establishing the right bank account structure, or building a reporting rhythm that actually works for the way you operate, that's exactly what we do here at 123 Financial Group. We work with small business owners in Newcastle and across Australia. The clarity call in the description is a straight conversation about where your business is and what would make the biggest difference. There's no pressure and there's definitely no pictures. And of course, it's important to remember that this information is general in nature and it does not take into account your personal or business circumstances. Please seek professional advice before making any financial decisions. It's important to remember though that a business with strong financial systems does not feel like it is surviving. It feels like it is actually running, and the owner feels like they are leading it rather than being dragged along by it. So I'd love if you gave this video a like if it helped, and subscribe, because next week we are talking about something that sits at the heart of why so many business owners feel like they are working harder without getting financially ahead. why so many of them end up paying themselves last. And remember, your business should support your life, and I'll see you in the next video.